Welcome to today's lesson on market capitalization. In the stock market, companies are categorized based on their size, which helps investors understand the type of investment they're making. Today, you'll learn about three main categories: large cap, mid cap, and small cap stocks, and what each of these means for your investment strategy. Market capitalization, often called market cap, represents the total market value of a company's outstanding shares. It's calculated using a simple formula. Market cap equals share price multiplied by total shares outstanding. For example, if a company's stock price is 100 rupees and it has 10 crore shares, its market cap would be 1,000 crore rupees. This metric gives us a quick snapshot of a company's overall size in the market. Large cap stocks are companies with a market capitalization of 20,000 crore rupees or more. These are well-established, mature companies that have been in the market for many years. They typically offer lower risk with stable returns, making them ideal for conservative investors. Large-cap stocks also have high liquidity, meaning you can easily buy and sell shares without significantly affecting the stock price. Examples include major banks, pharmaceutical companies, and technology giants. Mid-cap stocks fall in the middle range, with market capitalization between 5,000 and 20,000 crore rupees. These are growing companies that have moved beyond the startup phase but haven't yet reached the scale of large-cap companies. They offer a balance between risk and return, making them suitable for investors seeking moderate growth. Mid-cap stocks have significant growth potential as these companies expand their operations and market presence. Small-cap stocks are companies with market capitalization below 5,000 crore rupees. These are typically emerging companies in their early growth stages. While they carry higher risk due to their size and market volatility, they also offer the potential for high returns. Small-cap stocks can experience rapid growth, but they're more vulnerable to market fluctuations. These are best suited for aggressive investors with high risk appetite and a longer investment horizon. Let's compare the risk and return profiles of these three categories. Large-cap stocks have low risk with stable returns, perfect for investors prioritizing capital preservation. Mid-cap stocks offer moderate risk with balanced returns, appealing to those seeking growth with manageable risk. Small-cap stocks come with high risk but also high return potential, suitable for investors willing to accept volatility for the chance of significant gains. Understanding this spectrum helps you align your investments with your risk tolerance. Different categories suit different investor profiles. Large-cap stocks are ideal for conservative investors who prefer stability and long-term wealth preservation. Mid-cap stocks attract balanced investors who are growth seekers looking for opportunities between stability and aggressive growth. Small-cap stocks are designed for aggressive investors with high risk appetite who can withstand market volatility and are focused on maximizing returns over the long term. Choose based on your financial goals, investment timeline, and comfort with risk. Let's summarize what you've learned today. First, market cap determines company size and is a crucial factor in investment decisions. Second, each category has a different risk-return profile that matches different investor needs. Third, choose your investments based on your personal investment goals, risk tolerance, and time horizon. Finally, remember that diversification across caps can help reduce overall portfolio risk while capturing growth opportunities. Thank you for watching and happy investing.
If you like this video, hit that like button and don't forget to subscribe. Visit CodeLucky.com for more such useful content.